welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Cheenu Gupta, Senior Vice President, Fund Management Equities at HSBC Mutual Fund. Cheenu, good to have you back with us.
Yeah, hi. Yeah, same here. Good to be back.
Now, can you describe your journey as an investor so far? How did you start? What have been some of your key milestones?
So, I think the journey, in fact, in this market has been very interesting. It was almost about 2 decades back when the journey started. I started as a research analyst, and from then on, I think it's been a gradual progression, moving on to assistant fund manager and then a fund manager. The kind of learnings that you have are very different as an analyst. As an analyst, you learn to scan the companies in great detail, go almost to every nuance at the very fact how the management is doing the business, how the various ratios are moving, having a very close look at the companies. I think slowly and gradually, as the transition happens to being a fund manager, it's a lot more macro things which come into play. So it's not just the details of the sector, but also how the macro is shaping up, how I think the various tailwinds or headwinds playing out in an economy that start mattering much more. So overall, I think the combination has been interesting because I've been a research analyst. I like going in detail still till date. I like getting hands-on on any company, but getting the lens of a fund manager, you understand that how the various other dynamics can equally impact the outlook of the company.
Cheenu, how has your investment philosophy evolved over a period of time, particularly navigating, different and various market cycles? And what specific changes have you made in response to the global macroeconomic trends?
Again, for me, the learning has been, I'll tell you, initially, the focus was more on maybe the larger companies, how things are panning out. One interesting learning has been that when a large cap company tells you with a certain, understanding that they are supposedly going to have a growth of say around 10 to 15%, the confidence with which the company says it and the certainty with which it would be met would be very high. However, when it comes to a mid-cap company, that certainty goes down. It would be maybe around 75-80%. And when it comes to a small cap, that certainty goes down even lower, maybe around 50%. Almost 50% of the small cap companies do not meet the earnings guidance that they are giving or the confidence that they have. And the reasons have been varied. Larger companies have good financial muscle power. They have good balance sheet strength. So very little things actually impact them. When it comes to mid-scale companies, many a times these are B2B companies, these are supplier to some businesses. So what they deliver also depends on the outlook of the other company to whom they are supplying. And when it comes to the small cap companies, I think a lot more factors come into play. Even small things like how interest rate moves, because they are a lot more working capital dependent, makes a big impact on them. So understanding these things, understanding how the predictability of the earnings in various industries can move, I think that has been an interesting learning journey.
Indian equities, they've been hitting new highs frequently, but with global macroeconomic uncertainty brewing, do you think this rally is sustainable in the near term? And what market factors or risks concern you the most in the current environment?
I think interesting question today where we are poised is we are looking at, I think, a handsome year of outperformance by our mid cap, small caps, and even the large cap companies. Nifty have delivered good returns versus the global benchmarks that we can understand. Obviously, the macros of the country have moved in a very healthy direction. The current account deficit that we are talking about is in a very healthy range. If you talk about the currency stability, I think it's been one of the best. With all these various parameters, I think the country is poised at an interesting juncture. We are talking of a juncture where our per capita income is going to move in great stride in the coming decade. Even if we look at the policy measures, the reform exercise, etc., they've been in the positive direction. So I think if I look at the broad picture, everything stands in good stead. However, when it comes to valuation, I think I agree with you. We are at relatively higher valuation, and that creates some bit of discomfort. Normally, high valuations are always coupled with higher volatility. and I think which we've been witnessing recently in the markets. So at this point of time, I think it becomes even more important to be a good stock picker. When the valuations are cheaper, I think the broad market can give you that good upside. However, when valuations come at this higher range, then it's only the sum of the few stocks which can actually deliver earnings, and maybe the stocks where you can see transitioning from maybe a small cap company to a mid cap company, or a mid cap company doing well and transitioning to a large cap company. It is only these names, I think, which will stand out. So at this, I think, time of the market, we might look at some consolidation. A healthy time correction is something that could be called for. And as I say, that stock picking becomes very important.
Cheenu, we have seen around 5 to 6% of market correction in the last 1 week, and the correction has been continuous even to if we look at it, markets are down even today. So, do you think are you finding the opportunities in the current market scenario, or as you mentioned that the valuations are still expensive in some segments of the market?
I think, Chirag, you're right that yes, we've seen a lot of volatility in last 1 week. A lot of it has to do with the geopolitical events that are playing out. Right now, as we are talking, our country macros continue to remain very stable. Our outlook is great. But if you look at the situation, what's happening around, I think a lot of things are moving. Look at the tensions of the Middle East. They are at a different level. Russia-Ukraine, which started a long time back, has still not stopped. At the same time, we've seen China now coming out and trying its bit of stimulus. It's good in a way that global growth goes up. But when it comes from flows perspective, then it definitely has an impact where you tend to see some outflows going from the domestic markets towards markets like China. So these technical matters can create some impact for time being. However, I think looking at the perspective that we are talking about, if one goes on and picks good stock in sectors which are particularly coming out from the bottom, then you can still find good opportunities. So opportunities may not be many, but there still can be interesting opportunities.
Right now, with mid and small cap stocks, they have been a hot topic, with some arguing that they're overvalued while others see strong growth potential there. So how do you view these segments in the current market cycle, and how do you navigate this short-term volatility while focusing on long-term growth?
I think especially when it comes to mid and small cap companies, it becomes critical to understand things from various perspectives. First, understanding of management becomes very essential. The intention of the management, the orientation of the management, whether they are short-term oriented or long-term oriented, these things matter a lot. Their track record in capital allocation also becomes equally important. And as we've often seen in various phases, when the cycle starts turning, everybody is cautious. Look at the balance sheets now. We are having one of the healthiest balance sheets, low leverage. So everybody starts on a healthy beginning. Slowly, as the cycle picks up, there is a tendency to add on to the risk. There's a tendency to add on to leverage, or maybe take up projects where the risk might be higher. So I think now we are gauging towards a phase where we have to understand if the companies will end up taking up more risk than they'll be able to handle. So in the initial phase, understanding the potential of the companies becomes important. However, in the phase that we are in, maybe understanding how much risk that each company will end up taking and whether it can be within the limits, that should be more important. If we can stick to these things, a company which can execute well, healthy execution, good industry tailwinds, dynamics. In addition, if they can manage risk well, I think this combination can still help us find good companies in both these phases.
If you look at the portfolio of some of the equity funds which you manage, you are greatly or means majorly overweight on the industrial sectors. And we spoke last time when we met. Could you explain the rationale of being so overweight on the industrial sector, and what's the optimism that drives you being so overweight?
So yes, I think it's an interesting question, Chirag, and I must say that some time back, maybe say 5-6 years back, as fund managers, we all have been very bullish on consumption. Consumption in India remains an evergreen theme. Only the forms would have changed. Maybe earlier it was staples, then it came to discretionary consumption. Maybe now we are talking about convenience consumption. So forms have evolved, but consumption remains. However, what has interestingly picked up in the last 3-4 years is manufacturing. This is one piece which was actually missing from the entire piece of Indian investment. We always had our portfolios, oriented towards B2C companies. B2B companies didn't figure in our list. That is changing. With focus on Atmanirbhar Bharat, I think several areas have been outlined. PLI initiatives have been very directed, and we've seen gradually manufacturing chains and supply chains getting built within the country. I must say that it looks like we are still at the very beginning, and this would be like a decadal journey which is playing out, and hence very positive on manufacturing. Added to that, one more piece. If I talk about the capex spend, we all know that capex spend has picked up in the country. So if I look from a decade back, the level of capex that states used to do was 2 to 2.5 lakh crore per annum. It's now moved to almost 9-10 lakh crore per annum. It's like a massive jump, 3-4 times. If I look at the center capex, it used to be around 1.5 to 2 lakh crore per annum 10 years back. Today, that number has moved to 10 lakh crore plus. So again, 10-11 lakh crore. So again, a jump of almost 5 times. However, if you look at the industrial capex piece, I think that is still not coming. From a range of 4-5 lakh crores, industrial capex is still 9 to 10 lakh crores. So it's still like kind of moved in a very narrow range. And that is one big piece which is still missing and is yet to come in action. At the same time, we are talking about capacity utilization inching up slowly and gradually towards 76-77%. We are seeing that the balance sheets are clean for most of the companies. Leverage is low. Even the banks have good lending capability because they are at one of the lowest NPA levels. In this backdrop, it looks like that this big piece of capex which was missing can come into play. I think that is one reason that we are really positive on the capex-oriented companies.
Now, we saw that you hold some high PE stocks like Zomato, there's Trend, and some others as well. So, how do you assess the risk reward balance in these high valuation names, especially in an environment of heightened market volatility?
I think in consumption companies or maybe even in finance companies, it's been an interesting pattern that you see. Most of these companies reach an inflection point, at some time in their journey. So something like consumption shifting from unorganized to organized, I think this has been a theme which we've been talking about now for more than 10 years. So take an example of a sector like jewelry. Right? This trend has not been a recent one, it's been going on for years. However, I think for jewelry, the inflection point actually came perhaps in the year 2018-19 when one of a large jewelers, there was a fraud detected at large jewelers, they went bankrupt. And that is when the trust of people got shaken. They questioned the jewelry they were holding. And you started realizing that shift from unorganized to organized has started happening. So such changes, I think they come at a moment and the inflection point in the companies come in. That same way we are seeing the pattern maybe in apparel retail, what we are talking about. So somehow the shift from unorganized to organized in retail, especially in apparels, didn't happen. And the reason being people started at the premium end. Now, when somebody has cracked the model for the value retail, where this is the point you can actually see transition happening from maybe, unorganized to organized at a much faster pace. So I think this is one reason you're positive. And again, as I said, consumption in the country has been evolving. 2 decades back, we only spoke about penetration when consumer staples picked up. A decade back, we spoke about discretionary consumption and a lot of aspirational companies in discretionary categories picked up. And maybe now the new thing has been, where consumer has been willing to spend on convenience. So that has been the first of its kind. Indian consumer has always spent on value or maybe some bit on premiumization in last 3-4 years. But spending on convenience has been a very recent phenomenon. Maybe this could just be the beginning of the phase that we are seeing.
Cheenu, just wanted to understand on this particular thing, giving the high P ratios of 200, 300, don't you think so that once the revenue falls or, kind of thing declines, then there will be some correction in the P ratings and the stocks might underperform? Or is that not a concern for you?
So the app question, I think, should be whether you're getting the business model and timing in a company right. So PE ratios are very important, definitely. They are like the science of investing and they help you understand where you are relatively versus other companies. But I think a much more subtle thing is to understand where the industry or the company is shaping up. If we are too focused on PE ratios with a narrow lens, you might miss up on big opportunities which are shaping up. And it's true not just in India. In various other geographies, you've seen that if you've gotten too hung up at one parameter of valuation at the wrong time, you might miss an interesting piece on journey. You're not saying that a company will always remain expensively valued, maybe it would be just 3-4 years where a drastic change is happening in that company or that industry, where those valuations might stick. So I think as fund manager or as an investor, focusing on those inflection points becomes very crucial. At the same time, I think, yeah, P ratios, as you said, are very important. If the earnings are not met, or if a company starts disappointing, then a high valuation company is bound to face drawdowns.
There are few of the new age technology companies in your portfolios. Given the performance of that particular sector and some of the stocks, what is the outlook? What do you think is the future outlook of the e-commerce companies in India?
So I must say, Chirag and Ruchira, I was myself very skeptical on new age companies. The way the new age companies began, I think their entire focus was on getting those GMVs and the top line numbers with no focus on getting the profitability right. At times, you were even worried about the capital allocation that these companies might end up doing. However, there's been a change in their way of functioning in the last 3-4 years. Maybe they've understood that capital will not always be available. In between, they saw some tough times for a couple of years. And that is when we saw discipline coming in quite a few of these companies. Once that discipline comes in and they execute well, because they are in the new age areas which are just opening up, the growth that they can see can be really big. So I think the investment in new age companies always for us comes with a caveat that they will stick to the discipline with which they're doing things. In between, for growth opportunities, they might end up investing, which is okay. However, focus on execution, that has to be the key parameter.
But overall, how do you look at this particular sector going forward? And some of the new players are likely to come in through the IPO going forward.
Well, I think it's really an interesting space. It's like, a new space which is just opening up. So new players are bound to come in. But when an industry is expanding, there's always space for more and, many players to come in. It's only when the industry is kind of saturating or maturing, you're really worried about excessive competition. In the initial phases of any business or cycle, if more players come in, that just adds to the growth of the industry. Now, it's necessary in this journey that you pick a player who is good on execution. If that goes wrong, then there can be accidents. So the real assessment should be, I think, in that area.
Moving on to a couple of questions, fund-specific questions. So HSBC mid-cap and large-cap funds, they've outperformed in 2024. So what do you think are the key factors that have driven this strong performance? If you could highlight some investment strategies or stock picks that contributed to the success.
So I think here at HSBC, we have followed a framework of bottom-up investing. So we take the benchmark into consideration. We are aware of the benchmark, but the idea is not to kind of have portfolios which are benchmark hugging. A lot more focus is given on risk management through diversification at the stock level. But we can express our conviction in the portfolios through overweight on the sectors where we are bullish on. I think that has really helped the performance. Added to that, we had the local, stock picking practices and understanding of stocks on the ground level, but the risk management practices of global HSBC framework, I think those have been helpful. At the end of the month, we not only review underperformance, but also the outperformance if there are in the funds. So that has been an interesting exercise. Such monthly and quarterly reviews, I think they have helped. At the same time, I think there have been instances when a global team has questioned on certain balance sheet or cash flow items that are present in the portfolio companies that we are invested in. Maybe it's come up in some of the filters and they've checked. So I think such things have helped in taking risk into consideration at the same time while seeking out these opportunities. So these things have helped in the performances.
Before I come to the HSBC small cap fund, just wanted to understand on the large and mid cap fund, it has also outperformed brilliantly compared to the peers in the benchmark. What has worked for that fund?
So it's been a similar thing, Chirag, taking that approach. I am not sure if I spoke about it, but the way I look at the portfolio is looking at the stocks in 3 buckets. The first bucket is necessarily of the stability. So around 20% of the portfolio is for stability. These are the companies who are necessarily not outperforming, but have a very healthy track record, mostly the leaders in the sector. The next 50% of the fund is mostly driven by the companies which are the growth leaders. So they can either be the largest company or the second or third largest, but necessarily they are gaining market share in the industry they are present in. It may be because of their excellent execution, management capability, or maybe just, the business framework that they've designed. And the last bucket, I think that is the most interesting, which is kind of alpha generation for the portfolio, which is a 30% of the portfolio almost, where we look at new ideas, new ideas which are shaping up. So industries which are seeing changes happening. So instances where an industry is moving from a low ROC or ROE return profile to a high return ratios profile, or somewhere where there have been management changes, or some tailwinds picking up in the sector, helped by maybe government policies. So such sectors become very interesting because they are new ideas in nature. Necessarily the valuation that they are available at is not very expensive. And they help us, getting these new ideas in the portfolio, which help in alpha generation. If things go right, I think they move from the third bucket to the second bucket, the growth category. If at all the things go wrong, I think then we take action and we'll kind of put these ideas on. So over a period of 6 to 9 months, we kind of assess how these ideas have been doing, whether they've been meeting our expectations or not, and then take the action as needed.
So that particular 30% bucket has done well for you in such funds.
Has delivered in terms of meeting the new ideas.
If you could outline your current investment framework and what are the key principles that guide your decisions today during times of market uncertainty, if you could share your...
So in fact, Ruchira, I would say that times of markets uncertainty are the real test for a portfolio. Because these are the times that if you have picked on the right companies with the right potential capability to deliver, then these companies can manage to outshine even in the worst of times. And if, as I said, stock picking has been on the right side, then the portfolio can necessarily deliver better than how the industry is doing. So on and all, these are uncertain times. We are taking in cognizance of the volatilities. Our screening parameters have tightened. If on an earlier parameter out of 10 companies, 5 companies would have passed through the filter. Today, because of those tighter filters at higher valuations and volatile markets, maybe 2 or 3 companies will pass through that filter. So with that tightened filters, we are picking the companies and hoping for the best.
How do you balance growth potential with valuation concerns when selecting stocks, especially in the high value sectors like technology and the consumer facing companies?
I think looking at the valuation along with the growth ratio, the PEG ratio that we talk about, I think this tool becomes very handy, especially when we are looking at these industry or sectors which are delivering growth beyond the normal range. So when I say beyond the normal range, something like a 15 to 20% growth for a mid or small cap company, that's something normal. But if you're talking about, say, 30, 35% kind of growth, which may not last for a longer time, it can last for maybe 2-3 years of time. In that period, looking at the PEG ratio has been helpful. At the same time, looking at the various dynamics within that industry, the competition that is shaping up, the pricing power that is enjoyed by the company we are invested in, along with the government policy framework. I think these have been very critical parameters that we look at. Last and not the least, if valuations become too excessive for our comfort, we'll kind of prune on the weight that these companies have in our portfolio. So these have been the various measures that we've taken in these investments.
Are there any emerging trends or investment themes that are you really excited about? And are you closely looking at for the future opportunities in that particular sector?
I think, Chirag, these are very interesting times, as I said, for our economy. Various pieces of industries are just coming together and shaping up. Defense as a sector never existed in the past. I think with the government focus coming back, looking at the geopolitical situation and the kind of developments that our own companies in defense have done, for the long term, the sector looks good. Yes, in between the valuations can get excessive and there might be corrections, but I think interesting space shaping up. Again, as I said, manufacturing, one space which never really existed 5-6 years back. That is a space which is shaping up. Another sector, which is the power sector that we've spoken about. I think last decade has been a decade of underinvestment in this sector. And we knew that it was on back of the NPAs which got built up earlier. It's only now that large-scale investment have started in this space. It's only now that we are talking about investing not only in renewables, but also thermal and strengthening on the transmission and distribution line. So various companies in subsectors within power, they look interesting. At the same time, I think discretionary consumption it's changing its form. New companies are picking up in the space. And with the per capita income of Indians going up, discretionary consumption in that, I think that will look interesting. So on and all, these are interesting times. And I think a lot of spaces, new spaces to look at for investment.
I think with that, it's time for us to wrap up this chat. Thank you, Cheenu, for taking the time and speaking with us.
Thanks a lot.
Thank you.